I'm 75 years young. How can I get a mortgage?
Really simple, Paul. We lend to people far, far later in life. The last time you can apply to us for an interest-only mortgage is 89 years of age or 90 for capital and interest.
How is that possible? Let's talk through it. How can we do this? Come on.
Really simple. We look at clients far later in life than the average high street lender because we take their financial circumstances, their pension circumstances into consideration. So we'll use pension income, investment income to far later in life.
Yeah, so let's use an example. Let's say I'm looking to buy a property at 500k and I wanted to borrow 300k. How does that work being a retired person?
Really simple, no different to really being an employed person. So with employed people, you're just using their earned income, etc. With later life lending for retired people, then it's their pension income and their investment income that they're using. We'll use pension pots, SIPs, SSAs, we'll use investments to turn into income, and their fixed income pensions, so either a fixed income, the old corporate schemes, and including their state pension.
Okay, so age is not a challenge.
Age is not a challenge. So if I use an example, a 65-year-old coming to us for a mortgage, or let's use 66 because of state pension age, 66, they can still do a 29-year capital and interest mortgage.
29-year
29-year term.
At age 66?
Age 66, because we're just looking at their pension and investment incomes. They can be used forevermore, effectively.
Wow, that's incredible. So there's hope for me yet.
Very much so. And we see a lot of these people doing this. A lot of people are doing tax planning. They might be gifting funds away to their sons or daughters. They might be wanting to buy houses themselves and getting onto that property ladder by getting some funds from their parents. They're asset rich, they've got a large property, but don't necessarily have the ready cash to be able to do it. But they can take a modest sized mortgage to help that son or daughter or sons and daughters.
That's amazing. So it's truly is possible that if I was a mature person of that age, I could access capital to either buy. Was that applying to remortgages as well?
Absolutely. So you can do it either on a capital interest basis or on an interest only basis. Lots of people wanting relatively modest sized mortgages with large value properties. And we'll go up to 70% loan to value with downsizing on interest only, or 80% if they've got another repayment vehicle as well.
So what do you mean by downsizing on interest only? Let's talk through an example for people then. So that means I might be saying a £500,000 property and I want to move to, I don't know, a 1 or 2 bed flat or apartment in a different part of the country. So 500 becomes, say, 250. How does that work?
So we'll use that 500 and 250.
Yeah.
So if somebody was borrowing 250,000 and the property that they've currently got is worth 500, that means they've got £250,000 worth of equity.
Yeah.
We can potentially just say to you, use that equity. Where can they move to? Either in the local area, 5 to 10 mile radius, or if they've got family living in a different part of the country, will that 250,000 get them a property in that area, 1 or 2 bedroom as an example? If it does, that's what we mean by downsizing. They can do that. The most important thing is we have no minimum equity. It just has to meet the criteria. So that up to 70% loan to value. So if that 30% is sufficient to downsize, that's absolutely fine with us. Many lenders won't do that. And we've no minimum income on that. So there's no minimum income in terms of meeting the criteria for interest only. It just has to be the right income for the mortgage that they're borrowing.
And how do you make that work?
Really simple. Does it meet that minimum criteria? Does that income meet the criteria for that mortgage? And it can be state pension, private pensions, fixed income pensions, investments, etc. Top them all up. Does it meet our affordability criteria?
And I could borrow at age 89 even.
The last time you can come to us for either a residential interest only mortgage or a buy-to-let mortgage is 89. And we'll do a 5-year term for them. Alternatively, there is the retirement interest only mortgage, RIO as you might know it.
So let me get this straight. I'm 89 years young and you're saying I could have a retirement interest only mortgage, which means you'll lend to me until the day I die.
Effectively, or you move into long-term care.
Okay, but let's say I'm the oldest person alive in this world and I live till I'm 110.
Yep.
You will lend to me until I'm 110.
If you're staying in that home, if you're fit enough to live in that home and haven't gone into long-term care and you took a mortgage at 89, 110 would still be fine as long as you're making the repayments.
Wow, that's amazing. So there's so much choice available as a specialist building society. Incredible.
And this is the difference. The building societies, especially the specialist building societies, we are looking at ways to help borrowers to far later in life. The high street banks don't tend to do that. They use a lot of credit scoring, Paul, to do their mortgages. We don't. We look at each case on individual merit and therefore using pension incomes, using their investments to help them. It makes a huge difference. And if you look around, people are living longer, living older, they need help, they need support, they want to move house even. It can be as simple as that. They just want to move from one place to another. We can potentially help with a mortgage.
I think the education piece is so important because so many people don't know there is so much choice.
If you go back a few years, and not that many years in reality, it was all about equity release, and equity release has its place in the market. But our type of lending allows people to stay in their home, make a monthly payment without the worry of all their equity being potentially eaten up, as potentially equity release mortgages do. Ours are, this is where you're at now. If you want to downsize later in life, or you can do a capital and interest mortgage and pay that debt off and leave effectively a zero balance on the home, gift away to the family later in life.
So we've got retirement interest only, and how's that different to a traditional mortgage, borrowing at age 85 or whatever the number is we use?
So we've got interest only, retirement interest only. Interest only mortgages, we don't have to look at it, what we do call a debt stress test,
right?
Which is effectively if it's a couple, what's the situation if one passes away?
Yeah.
Retirement interest only, you're always looking at what happens if one of them passes away.
Okay, so like the pension pots, if that's what's being used.
What's transferable.
Okay, and that's how you assess it and underwrite it from a mortgage perspective.
Very different underwriting for the two. If you're looking at a retirement interest only mortgage, you're always looking at what's the lowest person's income, and then the second person, what transfers. So invariably their state pension won't transfer, their pension pot maybe only 50% transfers, so you're reducing the affordability for that client. That's why often we will see somebody take a standard interest only mortgage to quite late in life, and they might use the RIO then as the final stepping stone, the final product that they use.
And how long would you take option A for, and then when would you switch in terms of ages?
That's very much individual preference, because an individual client might feel they can wait to downsize to 80, or others might say, well, I'm happy to downsize when I'm 89. Individual preference.
Do most clients downsize?
Downsizing is often the tool that people use, but if they've got other assets in the background, they may choose to use those to pay the lender off.
Because when my father was unwell in his later life, he didn't want to leave home, he didn't want to downsize, he wanted to stay there and be cared for at home. So for him it was kind of interesting that at that time there wasn't any lenders to help, but now there is so much more choice.
Very much so. And it's individual preference, and you as an advisor would help them with that advice in terms of which product they're going to use. As I say, many people would be quite happy to downsize to quite late in life. There will be some who say, no, I'm absolutely not going to move out of this property. So that might be either they've got other assets in the background that we can potentially use to do a standard interest only mortgage, or we might just go down the retirement interest only route, because that allows you to stay in your home until either death or long-term care.
Incredible. What else do I need to think of then for later life lending? What's important if I was looking to help clients, or if I have mature friends that are looking to borrow? What are the key considerations?
What age are you wanting to take them to? How, from an affordability point of view? So,
and is that more like I want to live in this house till the day I die type scenario? And can I refinance care purposes? How does it work? What are the uses? What can I use my equity for in later life?
So us as a lender, we will happily lend to you for retirement, inheritance tax planning options, home improvements, gifting away to family members because they may be needing a deposit for a house, etc. We see a huge amount of cases where they're doing extensions to properties. Home improvements is a big part of what we do. And some it's just straightforward. They've got an existing mortgage. They had it when they were employed.
So for example, I've seen many cases where a high street lender have lent, but they'll only lend up to age 65 or to age 70, and they want to be repaid.
Absolutely.
And they force people to repay, which is really sad. And those banks and lenders that I've seen should really be referring business to you to say, hey, this is not a hard, you must repay. There are lenders that can help. And so many lenders that I see don't educate people to say there are other options available.
And that's where getting good financial advice is really, really important. Because as you say, I've seen so many cases where people have got to that 70 years of age, they've had an interest-only mortgage, and now the high street lender wants the money back. We will help those clients potentially right the way through to 90, 94, 95 years of age at the end of the term, and allow them to stay in their home. Or they may choose to change that interest-only mortgage to a capital and interest mortgage so that they pay the debt off. And we're an option for them to allow them to do that, whereas the high street lender just wants the money back, end of story, no ifs, no buts, and if they don't, then they'll look look to try and potentially repossess the house, or the client has to sell it.
And that's what I've seen in the times that I've been working in the industry, is that people have been forced to sell when really they didn't need to sell because there were other options, but no one knew of those other options.
And that's where it comes back down to good financial advice, utilising your mortgage advisors, utilising your financial advisors to get you that right advice, and using lenders like ourselves who do these later life products.
With these types of mortgages, how can we help family members? So if you're doing later life lending, can we use my parents' home to help my children and vice versa? What are the options available there?
So the modern guarantor mortgage, Paul, is joint borrower sole proprietor.
So the modern guarantor mortgage, because the guarantee mortgages don't really exist anymore.
No.
But the modern version does.
Yes, and that's joint borrower sole proprietor.
Joint borrower sole proprietor. What does that mean?
JBSP.
JBSP. What does that actually mean for normal people in the high street?
Okay, so this is where you might have, and we do two versions of this. We have parents helping their children with affordability, and children helping parents.
That I understand, but where's this joint borrower sole proprietor bit? What does that actually mean? So you and
my father, for argument's sake,
borrow money together.
Yep.
And who owns the property for what purpose?
So the applicant themselves, me, I would own the property, I would be on the title deed.
Oh, I see. So you and your father are helping each other help you buy a property.
Correct.
So you borrow together using his financial circumstances plus yours. So that's the joint borrower piece.
Yes.
For you to buy a property.
Correct. And my father in this example, he would be on the mortgage, but not on the title deed of the property. So there are no stamp duty issues from his point of view.
And what are the benefits and negatives of that? What's the positives and things?
So the main positive is you can often find that they can get onto the housing ladder sooner.
So that's you can get onto the market because of your father's position and it's a joint application.
Or on the flip side of that, me helping my father stay in his home because his income circumstances have reduced from when he was employed. My circumstances are strong, so I can help him stay in his home, attach myself to his mortgage and allow him to stay in that property.
So like a generational mortgage then. So basically what I'm saying is you and your father could help each other depending on how you needed help. So for him, so let's say he's got a high street mortgage and it's maturing, it's age 70, it has to be repaid. He doesn't have the income that he used to, you have the income. So you could then do a joint borrower sole proprietor mortgage. So that means he can live in his property for longer because of your income and you borrow together.
Absolutely. Intergenerational lending, as we would call it.
And then if you have children, you could help them get on the market too.
Yep.
And so how does that impact my own credit rating and affordability on other aspects of my life? If I wanted to get a credit card or a car loan or something, how does that work?
The mortgage will appear on the credit file, so you're going to have to disclose it when you do an application for any form of credit, and it will have some impact depending on your circumstances. Each person will be impacted differently, but yes, it will be sitting there as a second mortgage on your credit file if you've already got one, or you could be renting yourself at this moment in time. You will have to bear that in mind, that you're supporting the other person, and that can impact what you can borrow in your own name going down the line.
And when can you reduce your liability? So is there a time that if your father was borrowing and his circumstances have changed, that you can then, if there was a remortgage later, you could then come away from that? Or?
Absolutely. At any point, we will look to try and help you come off that. If the other individual can afford that mortgage in their own right now on our affordability, then we can potentially just remove the other person, obviously through the legal process.
The joint borrower sole proprietor is today's modern version of a guarantor mortgage.
Absolutely.
Fantastic. And is there anything else I need to think about in terms of ages, criteria?
No, it comes back down to, so if we will restart a mortgage right the way through to 89 on interest only, 90 on capital and interest, the only thing you might want to have to consider is the younger borrower. If you're using their earned income, we'll be taking that to 70 or 75 years of age. So you've just got to watch that the two terms match up in what dad in that example and what son needs in that example.
Fantastic. Paul, thank you so much.
Pleasure.
Learning all the time. So, whatever your age, 65, 89, you could even borrow to 110 if you really want to live that long and have a mortgage. Anything is possible with later life lending. It's important to seek the right financial advice and speak to the experts to help you with this process. As always, thank you for watching. Please remember to like and subscribe. It helps the channel enormously.